Next question now comes from Jake V. Again, this was an email. Jake says, "Good evening. My name is Jake and I am single, not married, 26-year-old, and I am a law enforcement officer who makes a base salary of $76,000 a year, but I should make between $85,000 and $95,000 after overtime and bonuses. I just bought a house. My mortgage is $2,100 a month. I pay $600 a month in student loans at a 7.1% interest rate. I have a 457B through Nationwide that I contribute $300 a month with, and I invest in their aggressive strategy. I have about $6,000 in the stock market through a Schwab account and another $4,500 in my emergency fund through Discover. I contribute about 3% of my paychecks to my pension plan, which will pay 90% of the average of the highest 5 years annually when I retire, which might be 55 or so. Here's my question. Keeping into the account that I would still like to have some money left over every month to enjoy my life, take vacations, things of that nature, how could I manage my money better? Should I open up a Roth IRA as well and contribute over there? Or is my pension and my 457B enough? Should I pay off my student loan debt faster, or should I focus on increasing the balance in my emergency fund? Any advice you guys have is greatly appreciated. I thoroughly enjoy listening to your podcast. Thanks in advance, Jake." Robert, you want to kick this one off?
Yeah, this is a confusing one because although he's a high earner, and I love that because that's going to continue to grow, I definitely think you shouldn't just have the 457B just because you don't have full autonomy over that account. You don't have autonomy over what it's invested in. And many times it might underperform the markets over the years. So at your age, I definitely think you should get the Roth IRA set up as soon as possible. But before you start maxing out the Roth IRA, I would make sure to get all of your high interest debt paid off, because at the end of the day, you hear Austin and I say every single week, you can't out invest high interest debt. So I would start there, but get the Roth set up. And as soon as the high interest debt is under control and gone, then I would start maxing out the Roth IRA to make sure you have that after-tax money going into retirement, because right now at 26 years old, it's an incredible time for you to get started early, invest consistently in the Roth IRA, and really set yourself up for financial freedom later on.
Yeah, so I agree. And I want to walk you through step by step here. You're 26, you're a law enforcement officer. Appreciate you, protecting your community. I think that's really noble of you. And shout out to all of our law enforcement officers, military firemen. Shout out to my friend Jonathan, who's a fireman. He's pretty cool. But what's important here to understand is you are in a situation where you might have a pretty tight monthly budget. You're taking home just about $5,500 a month, if I did my math right, after taxes, contributions, things of that nature. And then once you take out the $600 a month in student loans, $2,100 a month in mortgage, and probably just being a 26-year-old, you might be, I'm not going to say you're living paycheck to paycheck, but you're pretty close, right? You might have wiggle room of maybe $500, $700 a month, which is cool and it's useful. But I just want to make sure that there are different things that we should do here to ensure that you have a little bit more breathing room. So the first thing I want to do is beef up this emergency fund. You've got $4,500 in there. I guarantee you that is 1 month of savings, right? I want you to have 3 to 6 months of savings. So the big goal for this year between, June when this comes out and Christmas in 6 months from now is to get this emergency fund to at least $10,000, maybe 12 or 15 if you can get there. But you want to have at least 3 months of expenses in this account, because what's going to happen here is there's going to be a funeral. There's going to be a last minute, something that goes wrong with your car, something, your AC is going to go out in the home that you own. Something's going to happen that's going to be $3,000, $4,000, $6,000, $7,000, or maybe it's a bunch of little things that happen over the course of 2 months that just wipe you out. And when it happens, it's going to suck. For example, I haven't even told Robert this yet. My microwave broke yesterday. So not only did my dishwasher break, but now my microwave's broken. So I gotta go buy a new microwave, right? Stuff like the joys of home ownership. What I'm saying here is the first thing is to get that emergency fund beefed up. That's the most important part, because that's what's going to give you some breathing room between life and you. The next thing I want you to do is, yes, open up that Roth IRA. Robert and I think it is the best way that anyone can begin to save and invest for their retirement. Open it up on public, get the 1% match, and max it out. That's $500, $600 a month. You can absolutely do that once you're done beefing up that emergency fund, okay? Now, once the Roth IRA is rocking and rolling, you've got probably at this time $10,000, $20,000, $30,000 invested maybe across your 457, your pension, your Roth, you got this, 10, 15,000 saved. Now maybe it's time to consider knocking out these student loans. 7% interest is nothing to sneeze at. Definitely right in the middle where it's like on the bleeding edge of like, I don't like the debt. It's getting kind of up there. $600 a month tells me you probably have 40, 50, 60, $70,000 of student loans. Just follow the rule of thumb that Robert and I always share when it comes to paying off student loans. Before you pay off your student loans aggressively, assuming a reasonable interest rate, which is what you have, make sure you have the equivalent amount invested across your accounts. That would be a bridge account. Maybe that's this 457B, your Roth IRA, your emergency fund that's earning interest, right? Just make sure you have the equivalent amount of your student loans working for you before you now go take this tens of thousands of dollars of money that could be invested to go now pay off these loans. Because freeing up $600 a month for you, let's say you're able to do that in the next couple of years, that $600 a month is your Roth IRA, right? That is what's going to turn into millions of dollars in retirement. So there's definitely a world where you could begin to open up some of the breathing room in your budget, invest more aggressively in your 30s, and become a multimillionaire by the time you're ready to retire.
The only thing I want to add to this would be get your budget handled. We have a free budgeting tool that anyone can grab. It'll be linked in the show notes. Everyone needs to understand where they're at monthly so you can figure out how to get that high interest debt paid off. Get yourself on that honest budget we talk about all the time, and you will be set up for life. Get everything dialed in, and you'll be good to go.